In this video, we're going to be covering notes receivables. You'll notice that in Chapter 17, there is a section for notes payables and notes receivables. We'll cover the notes payables in another class, but for Accounting 1, we're only going to be looking at the notes receivables. A promissory note is a written promise to pay a specific sum at a definite future date. So notes are often used when credit is extended for 60 days or more. You know, an accounts receivable is typically due in 30 days. So if a customer needs a little longer to pay, they may choose to issue a notes receivable in the place of the accounts receivable. Now, notes must be signed by the maker of the note. That's the person who promises to pay the sum of money later on. And it must be payable to a specific person or business, and that person is known as the payee. A note must contain the following information. It must list the principal, which is the amount that was borrowed. The interest must be listed, which is the amount charged for the credit, your interest rate. The due date of the note should be listed on the note. The time or the term of the note. How many days until the note is due, in other words. It could be a 1-month note, it could be a 60-day note, or a 90-day note, or a 3-month note. The maker of the note, who is the person promising to pay, must sign the note for it to be legal. And the payee of the note should also be listed on the note, and that's the person who will be receiving the money at the specific due date. Okay, here is an example of the note. Now, a note doesn't exactly have to look like this, but all the elements of the note should be listed on it. So here we have the payee, which happens to be Central Bank. The maker of the note is Sarah Morney. She is the person promising to pay Central Bank. And the date it was issued along with the due date, that's also called the maturity date. The term is not specifically listed, but you can figure out the term by counting the number of days from the date of the note to the maturity date. The principal here is listed along with the interest rate, and notice we've got Sarah's signature here. Now, one of the things that you'll be asked to do on your quizzes, homework, and exams is to determine the due date. So, of course, the due date is the date on which the note must be paid. The term can be in months, or the term can be in days, and it does make a difference. For example, a 2-month note may not be due on the same day that a 60-day note would be. For example, if we have a 2-month note dated January 17th, it's going to be due on the same day 2 months later. So we'll just count ahead 2 months, February, March. So March 17th is our due date. In this example, we have a note that is due in 60 days. It originated on March 15th. So if this were a 2-month note, it would be due on May 15th. That's exactly 2 months later. But since it's a 60-day note, let's look at the process that we're going to go through here in order to figure out the exact day that it's going to be due. All right, so the note originated March 15th. We know that there are 31 days in March, and if we subtract the number of days that have passed, which is 15, we have 16 days remaining in March. Okay, then if we add all the days in April, which is 30, will be at day 46. So we can't add another month. That'll take us over 60. So to get to the days left on the note, we just subtract 60 from 46. So we know that there are 14 days left on the note at the end of April. So that makes the note due on May 14th. So it does make a difference whether or not the note is in terms of months or in terms of days. We'll find the due date of one more note for just a little bit more practice. So here we've got a 90-day $5,000 note issued on May 2nd. So we need to figure out what the day 90 is after May 2nd. So I'm going to pull over a spreadsheet here. So we started in May 2nd. There are 31 days in May, and 2 have passed. So that leaves 29 days left in May, and then the next month is June, and it has 30 days. And then the next month is July, it has 31 days. So if we stop to add up our days to see where we are, we're already on day 90 of the note. So July 31st is going to be the due date of our note. In this example, we've got a 3-month $5,000 note issued on May 2nd. So if we count ahead 3 months from May 2nd, that would be June, July, August 2nd. So for 3 months, the due date's a little bit later, on August 2nd. Now we need to make sure that you know how to calculate interest. Interest is the principal amount times the interest rate times the time or the term on the note. Okay, remember the principal is the face amount or the amount that was borrowed. The rate of interest will be in the form of a percentage and listed on the note. And then the term, the way we enter that when we calculate our interest really depends on whether it's in terms of days or months. And we'll look at some examples. When the term is specified in months, the time will be calculated on the basis of months. For example, if it's a 3-month note, you would enter a fraction of 3/12. That's 3 out of 12 months. If the term is expressed in days, we're going to use the number of days divided by 360 days. Now we know that there are 365 days in a year, but banks often use a rounded 360 days. So if we had a 92-day note, we would calculate our interest with a fraction 92 divided by 360. That's 92 out of 360 days. Okay, here are some examples. We have a $4,000 60-day note and it has a 10% interest rate. So our principal is $4,000 times the rate of 10% times 60 divided by 360 because it is a 60-day note. In example 2, we've got a 3-month note for with a principal of $50,000 at a rate of 4%. So the principal is $50,000 times 4% times 3 out of 12 months. So the time is really important when you're calculating interest. And if students make mistakes, it's usually with the time component. So if you did principal times rate, you would get an interest figure for 1 year. So if the note, if you're calculating interest for less than a year, you have to make sure and get that time in there. Notes receivables are listed on a company's books as an asset because they represent something of value that will be collected at some point in the future. Now, notes receivables generate interest revenue. So when we calculate the interest on these notes, we will record it as revenue on our books, and it will be listed down at the bottom of the income statement as an other revenue. Notes receivables can originate in a couple of different ways. One is a customer may issue a notes receivable to the company in exchange for an asset. Sometimes if the asset is very expensive and the customer needs a little bit more time to pay the asset off, he may issue a note instead of an accounts receivable. If a customer already has an accounts receivable that he knows he's going to be unable to pay, he may offer a notes receivable in its place to extend time for the payment. And every once in a while too, a company may loan an employee or another individual money, and that would also originate in a notes receivable. In this chapter, we're going to be able to journalize a note collected at maturity, a note renewed at maturity, a note discounted before it matures, a dishonored note, and then collecting on a dishonored note. A company may agree to accept a notes receivable because it is a formal and legal written promise serving as proof of a transaction. It can bear interest where an accounts receivable does not, so that would be a little additional revenue. A notes receivable is negotiable, so it is an asset that we can actually transfer for cash. Sometimes a bank may agree to purchase a notes receivable for us in exchange for a reduced amount. And then a note can be pledged as security. So there are some advantages to accepting a notes receivable from a customer. In this example, we have the origination of a note. On June 1st, Lanesh Hardware sells an industrial mower to Williams Manufacturing for $8,500 in exchange for a 180-day 8% note signed by Williams. So the company has made a sale, and instead of an accounts receivable, they have accepted a notes receivable. So we've debited notes receivable and credited sales. In this example, we are accepting an accounts receivable to extend time for payment. So we've got an accounts receivable sitting on the books from a customer named Michael Putter. He owes us $2,000. So to settle the accounts receivable, Putter is going to issue a notes receivable in its place. So we have accepted a notes receivable from Putter for $2,000, and we're going to remove the accounts receivable of $2,000 because the notes receivable has replaced the accounts receivable. So instead of, unfortunately, getting cash, we're getting a notes receivable. If Michael Putter gives us a check for $250 and a note for $1,750 to extend the time for payment, we would of course collect the cash of $250 by debiting cash and then only debiting notes receivable for $1,750 and then removing the accounts receivable. So instead of issuing the note for the entire amount, in this case Putter gave us $250, so we only issued the note for $1,750. Next, we'll look at the collection of a note at maturity. So when a notes receivable comes due, it can be collected by the payee, or it may be collected by the bank named in the note, or a bank where it was left for collection. Sometimes the payee, instead of collecting on the note, will ask the maker to submit that payment to a certain bank. In this case, Putter pays Lanesh the $2,000 principal plus the $37.50 interest owed on the note. So let's go back and just double check that interest calculation. This was $2,000 at 7.5% for 90 days. So 2,000 times 7.5% times 90 divided by 360, and that'll give us $37.50. So we're going to debit cash for the full amount of the principal and the interest, $2,037.50. And then in the credit, we're going to remove the notes receivable with the credit of $2,000 from the books. And then we will record the interest revenue of $37.50. So remember, revenues are always on the credit side. And another thing to remember is that the notes receivable itself will always be for a principal amount. It won't ever have any interest included in it when you're debiting or crediting it. In this example, it says, what if the note had been left at Planet Bank for collection instead? If Planet Bank collects this note for us, of course they're going to probably charge us for that. So in this case, they charged us $15. So if we take the $15 out of the $2,037.50, that leaves us to collect $2,022.50. So we will debit cash for the amount with the service charge netted out. We will record that $15 as a debit to collection expense, and then the credits will stay the same as they were before. We will remove the note at the principal amount, and then we'll record the revenue in the interest revenue. When a bank collects for a company in a case like this, typically they're notified, or the company is notified with a credit advice that looks something similar to this. It might be listed on the online banking statement, or it will definitely be on the bank statement, or you may get something like this in the mail. What if Putter paid only the interest due and asked to renew the note? So this sometimes occurs when the maker cannot pay the note in full. Sometimes they'll give us just the interest, or maybe the interest and a little bit of the principal. So in this case, Lanesh only collected the interest from Putter, and then he is going to renew the note to replace the original note. So Putter gave us $37.50. That's all we received as far as cash. And that was interest revenue, so we'll be sure to credit interest revenue for that $37.50. But then we're going to remove the old note and replace it with a new note. And this is important because once the due date of the old note passes, it's really no longer valuable. So it's important that we get a new note with a new signature. So we physically show that we are removing the old note and putting the new note on the books. All right, in this case it says assume Putter pays $37.50 plus $500 of the principal. So we have another brand new note. We collect the principal of $500 plus $537.50, and then we're going to remove the old note. That principal was $2,000, and we'll put the new note on at $1,500 because he did pay down $500 of the principal. And then of course we'll also record the credit for the interest revenue of $37.50. And before you leave the transaction, always make sure that debits equal credits, and you know there's less possibility of a mistake that way. Now we'll look at discounting a note's receivable. Sometimes a business needs its cash before the due date of the note. So for example, you might have a 90-day note for $5,000, but you would like to have your money earlier. You need it. So before we said that a note's receivable can be negotiated. So what we're going to do is endorse that note's receivable and transfer it to the bank. Now, of course, the bank is going to charge us for that. They don't do that out of the goodness of their heart. They charge an interest fee called a bank discount. And the discount period is the time that the bank has to wait for the maker to pay them the principal and the interest. So the discount period is the time between the date that the note was discounted and the due date of the note. The maturity value of the note is the principal plus the interest on the note. That's what the bank is going to base their discount on. And then the difference between the maturity value and the discount that we calculate is called the proceeds. So that's what the bank is willing to pay us for that note. So we'll put this in action now. The formula for calculating a discount is maturity value times the discount rate times the discount days. So assume the $2,000 7.5% 90-day note from Putter dated June 8th is discounted at the bank on July 8th at a rate of 8%. Okay, so the maturity value is pretty easy to calculate. We can calculate interest. So when this note matures, what will it be worth? It will be worth the principal plus the interest on it. So $2,000 at 7.5% for 90 days is $3,750. So when this note matures, it will be worth $2,037.50. That's the maturity value. The next step in calculating the discount is to figure out the discount days. So that, remember, is the number of days from the date the note was discounted until the due date. So if you did it the hard way, you would have to figure out the due date and then count the number of days from the discount date to the due date. But there's an easier way to back into that number. So we are going to figure out the number of days that have passed on the note. So we know that this is a 90-day note, and it originated on June the 8th. And then we discounted the note on July the 8th. So if we counted the number of days from June 8th to July 8th, that would be 30 days in June minus 8 days is 22, and then 8 days in July would be 30. So 30 days have passed on this note. If it's a 90-day note and 30 days have passed, then we know that 60 days remain in the discount period. So the bank has to hang on to this note for 60 days until it matures and they receive their payment. Step 3 is to now put all 3 of the elements together, compute the discount. So our maturity value was $2,037.50. The discount rate was 8%, and then the discount days are 60 out of 360. So our discount is $27.17. Now, that was the hardest part. We have to calculate the discount, but we don't put the discount on the books anywhere. This discount is what the bank made on this particular arrangement. What we have to do is calculate the proceeds from this note. So we had a note worth $2,037.50. the bank is keeping $27.17, so they're going to issue us a check for $2,010.33. So they're buying this note for $2,010.33. So to enter that into our books, we debit cash for the $2,010.33. We remove the notes receivable from our books because remember we've sold it, so we're going to credit notes receivable for $2,000, and then the difference between these two will either be a revenue or an expense. In this case, we received more than the face value of the note, so it's going to be listed as an interest revenue. If the proceeds happen to be less than the face value, say the proceeds were $19.92, the face value of the note's $2,000, so we actually received less than the face value, so we have to debit $8 to interest expense. So if it's more than face value, like in this example, then we're going to credit an interest revenue for the difference. Since it's less than face value, we're going to debit interest expense for the difference. Now sometimes the maker of a note doesn't pay the note, they don't renew the note, they just dishonor the note. The maker is still liable to the company for this note, but it loses its legal status. In other words, you can't sell a note that's past its due date. Nobody's going to want that, so the note cannot be negotiated now. In our example here, we're going to assume that this note has not been discounted. It's just a regular notes receivable that we've been carrying on our books as an asset. So Putter says he's not going to pay. So in order to remove the note from our books, we're going to turn the total amount that Putter owes us into an accounts receivable. So Putter owes us $2,000 principal plus $37.50 interest. So we'll debit accounts receivable for $2,037.50, credit notes receivable to remove the notes receivable from the books, and then credit interest revenue. Even though we haven't collected it, we've earned the interest revenue. So in accrual accounting, revenues are recorded when they're earned. So we're going to credit interest revenue for $37.50. If the note had been discounted at the bank, that's kind of a whole different entry. The bank is going to require the company to now pay what the payee didn't pay. So Lanesh was the person owed the money. Lanesh sold the note to the bank, and the bank didn't collect from Putter. So what happens is now Lanesh has to cover what Putter should have paid. We're given some information here to say that the bank is charging a $25 bank fee on this dishonored note. So we are going to debit accounts receivable Putter for the amount of principal, interest, and the bank fee. And then we're going to credit cash for $2,062.50, because remember the note has already been removed from our books, so we don't have to worry about that. We removed it when we sold it to the bank, but we do need to make sure that we put this accounts receivable on here from Putter for the total amount that we had to pay the bank to satisfy the note. Now sometimes we'll collect on a dishonored note. Maybe the payment is just a little bit late. In this example, it says on October 16th, Lanesh collects from Putter after the note had been discounted and dishonored. And it says Putter pays the original maturity value, the bank fee, and the additional interest. So that, remember, that total $2,062.50. And an additional interest at 7.5% for the period since dishonoring the note, which was 40 days. Okay, so if we go back, we look at our accounts receivable. Putter owes us $206,250. So we're going to apply the 7.5% rate to the $206,250 times the number of days that the note was late times 40 divided by 360, and we'll get $17.19. So Putter is going to give us a check for the that should say $62.50 plus the $17.19 for a total of $2,079.69. So we'll debit cash for $2,079.69, remove the accounts receivable that we had previously debited for $2,062.50. We'll remove that with a credit, and then record the interest revenue of $17.19. At the end of the year, for every outstanding note, we need to enter a journal entry for accrued interest. Now, accrued just means added up. So all the interest that has been added up on a notes receivable and has not been paid needs to be recorded on the books as accrued interest receivable. In our example, we have a note for $800. Its date of issue was May 19th. Now, we're assuming that our year end here is June 30th. So interest has added up from May 19th until June 30th. So if we calculate the number of days from May 19th to June 30th, May has 31 days and 19 have passed, so we have 12 more days in May and then 30 days in June. So that comes up to 42 days. So we just calculate the interest on this $800 for 42 days. 800 at 8% times 42 divided by 360 will give us interest of $7.47. On the $500 note, it is dated June 20th. So interest has added up from the June 20th to June 30th, and that's 10 days. So 500 at 8% times 10 divided by 360 is $1.11. So at year end, we will perform an adjusting entry, debiting accrued interest receivable for $858 and crediting interest revenue for $858.